Hi everyone, this is Rose from Lifestyle Mastery, and I'm excited to have Jenny Fielding, who's one of the most active global pre-seed investors, and she's the co-founder and managing partner of Everywhere Ventures. She's also the author of the new book, Venture Everywhere. Welcome to the show, Jenny.
Thanks so much for having me. Excited to chat.
Awesome. So you've been very active on Twitter. I've been following you for quite some time. But how did you get your start in the venture capital world?
I feel like everyone now, talks about my punchy Twitter, but I actually started, a very traditional path. So I live in New York City. I went to law school. I worked at J.P. Morgan. So I was taking a very, let's call it, traditional New York corporate path. And then a long time ago at this point, in 2008, I came up with an idea for a startup. And I didn't even really call it a startup, honestly. I just had a problem that I personally, saw an annoyance in the world that I wanted to be solved, and it was in the mobile telecommunications space. So I set up with some co-founders in my apartment, as many folks do, and bootstrapped this company. At some point, we actually had revenue, and everyone said, Jenny, I think you're going to need to leave your job. I was like, oh, okay. So, as you can imagine, 2008, there just wasn't, much capital available. There certainly wasn't venture capital.
Yeah.
So we had to be very scrappy. We had to bootstrap, and we just couldn't expect other people to bankroll us. So that was where it all started. Started as a founder, went on to found another company, and then ended up on the other side, to the dark side. First as an investor at Techstars, so in New York, running Techstars New York and some of the vertical programs, and now at Everywhere.
Interesting. And you started two mobile software companies. So were you able to get exit out of those companies that you launched?
Yeah, first one, I got very lucky. So, there's a lot of hard work in running startups, but there's a lot of luck in terms of timing. And so we can never forget that as both investors and founders. So in my first one, you can imagine the iPhone launched, I think, in 2007. So anything around mobile technology was super exciting, was hot. And if you happened to be building in it, you got a lot of attention. So I like to say, although we worked really hard and I think the idea was quite good, we benefited from the zeitgeist of everyone being super excited that all of a sudden you had this supercomputer in your pocket and all the things that you could do with it. My second company, I did not get as lucky, although I still think it's a great idea. It was a text message marketing company. And unfortunately, at that time, 2009, 2010, people, at least in the US, weren't really ready to get marketing on their phone. Their phone still felt like a personal place where you called your mom and you got important information. And unfortunately, we had to shut down because we couldn't find product market fit. The irony, of course, being that we've seen many companies go on to huge success in the text message marketing space, and it was just a little bit ahead of its time. So I always think that that's what keeps you humble as both an investor and a founder, is that it's not just about, great ideas and new ideas and kind of seeing the future, but if you're too far ahead, that can also backfire. So those were some of my experiences, both with a good exit and good market timing and one that didn't work out so well.
It's interesting, because I'm Indian, and I've seen a lot of companies back in India would promote on WhatsApp, but that's something which is not done here in the UK or in the US. I hope they don't bombard the messages across this platform. But you've been a operator and a founder. Why did you go on to become a VC? Why not build more companies since you already done twice?
Yeah, I mean, I was actually working on my third company when I came across the folks at Techstars who ended up, hiring me and basically convincing me that learning about the other side, about venture capital, could be a great addition to my toolkit. Whether I was a founder or an investor, learning about the other side was really important. And honestly, I learned something about myself, which was I was a pretty okay founder. I had a lot of quirks and a lot of things I did wrong. But I was actually a really good kind of 0 to 1 investor. So not just about the investment part, but really about sniffing out interesting people, trying to understand what makes them tick, and ultimately like a pretty good picker. So in my early days, I ended up backing a few companies that went on to become unicorns and are still dominant players in the market. And so what I realized about myself was, sometimes when you're building a company, you can't see what's right in front of you. You need someone to help you. And that honestly, I was like really good at helping people see what they potentially couldn't see themselves. And that was kind of my superpower. And so at that super early stage, just surrounding founders with, the knowledge, the resources, the support, was really critical. It was something I didn't have when I was starting my companies because it was a kind of different time. But that was something that I could bring to the table, and I was pretty good at it.
Interesting. Yeah, I've had Brad Feld who've come on the pod. I'm a big fan of Brad. But how's been your experience with Techstars? Is it very similar to what you get it at Y Combinator or 500 Startups? It's one of the top 3 accelerators in the world. But how was your experience running Techstars?
Yeah, I mean, it was magical for me. It was kind of the early days. So I joined in about 2014. The company was still rather small. I think, there was a handful of programs, and I think there was only 25 people full-time when I joined Techstars. So it felt like a startup in and of itself, and it felt like we were doing something different, which was not necessarily backing founders in the Valley who kind of had a lot of access already, but looking at founders everywhere else and how we could support them. So it was a critical time for me. I think I learned a ton, not just about investing, but about building your top of the funnel, cultivating a community and a network, and how that community could actually help your portfolio and ultimately support your portfolio. So I definitely learned a lot through not just a traditional investing fund, but through this really innovative accelerator model, which now I think people are pretty familiar with. But back then it was a different model.
Interesting. And did you want to venture out and create your own fund? How did how do you think about building Everywhere Venture and building this community for founders and investors?
Yeah, so the first thing I'll say is that when you build a microfund, it is much more similar to building a startup than it is to becoming a investing partner at a large VC fund. So the number of hats that I wear in every day is the number of different things I need to do, different stakeholders. It feels much more like being a CEO of a startup, and I actually like that. I think the diversity of what my day looks like, whether it is, brand and going on podcasts and expanding, our name out there, whether it's working with founders in our portfolio, finding new founders, or, raising money from LPs. Like, that's all part of the job, not to mention that we have a team we need to manage. So you get to do a lot of different things. So, the job is pretty unique. And that's the part I really like about it is the diversity of what you get to do. So that's kind of, I love to say that to people because they're always like, what was the shift from going from a founder to an investor or spinning out? And I'm like, honestly, all these things, the common thread is really starting something new and, creating your own path. And that's honestly what the book is about as well, which we'll get to. But It's about, not going after the conventional job or path and, charting your own course. So the decision to kind of spin out and do my own fund was very organic. I saw, something that I felt like was missing in the market, and especially in New York City, where I felt like there was, all these great founders. There were all these now second-time founders, and there wasn't really a mechanism for connecting them. So our first 2 funds, I was actually still working full-time. And we started them kind of as proof of concepts, right? To prove the thesis. Could we create something called community-powered venture capital, where our LPs, our backers, were other founders and operators. And I think, this had probably been, tried in a few other ways, but we were definitely one of the first to kind of come out full force saying that other founders make great investors, and founders are great top of the funnel deal flow, and ultimately founders give good advice. So if we can kind of marry that trifecta, we would have something special. I think now you hear more people doing it, operator networks, et cetera. But
Sure.
when we conceived this in 2017, it was definitely more unique.
Got it. And I've been an operator in Techstars, but I had a question for you. Should founders who at least raise series and above, should they run their own syndicate or should they run their own fund, or should they be like an LP in a fund?
That's a hard question to answer. I'd say it's probably a mix. So if you're someone that is, really excited about the fund process, which again is not just about investing, it's about managing other people's money, which has a lot of components, and you have the time and acumen, then I think, by all means, running a syndicate or your own fund can make sense. I'd say most of the founders that I know are pretty busy being founders.
Yeah.
They're grinding really hard, and for them, being an LP makes a lot of sense. I'd say one of the draws for that community to everywhere is that they really get to be along for the ride. So this is something pretty unique, is we don't make a big distinction in our portfolio between who are portfolio founders and who are founder LPs. We really provide the same kind of access and community for them. So we have a Slack channel with all of those people. So we have 500 founder LPs and another 500 portfolio companies, and everyone is kind of mixing, supporting each other, say in our Slack channel, has access to our CRM and kind of the suite of collaborative tools that we've built. They're welcome to come to all of our events. And so mixing that community, I think, is what's really interesting. And the overlap, as you can imagine, we have a lot of LPs that now have become portfolio founders. So again, it's kind of taking it out of those clear boxes and saying, there's a lot of mix between these communities. So why don't we just build a premier founder community and not worry about what label we put on them?
Correct. And you focused on pre-seed and seed, and I've seen the last 10 years there's been an exponential rise in new funds. I think the last 2 years have been difficult, but does seed and pre-seed even make sense as an asset class, and why are you so bullish on that?
I mean, if you ask the companies that in our portfolio that are now, much later stage, they'll say that, whether it was me or it was, some other pre-seed or angel, back them when no one else would. So yes, there's a whole cohort of founders that are second-time founders, and they can command capital from lots of people. But I'd say our sweet spot, first-time founders, who have big visions that maybe most people don't kind of get. They need the support early on, and to be able to be kind of the first believer. Not just writing the check, but kind of moving them into a community that can support them. Is incredibly necessary and rewarding. So there's very few startups, I think, that can just bootstrap and then go to a Series A. Potentially there is that cohort in places like San Francisco, but I'd say for the vast majority of startups, the capital, the community, the content, it's all kind of that early support that founders need.
Interesting. And, in my operating experience, I worked with a founder who was a Thiel fellow and another one who was a Forbes 30 under 30. When you're looking for a first-time founder, are you looking for somebody who's very experienced, or are you looking for somebody who's young and scrappy and would want to learn more into that market?
I wish I had the perfect archetype to talk about. Then my job would be a lot easier, and the whole industry would be, I think, transformed. The truth is, we have everything in our portfolio. We have second-time founders, first-time founders. We have founders that have worked in the industry for 15 years. We have founders that are, we have a company called Pear Eyewear. I think we met these founders. They were still in university. So we backed them while they were still students. So we have everything in between, and we actually haven't seen a lot of patterns. I think the things that we're looking for are founders who have a secret about a world that maybe doesn't exist today. And so you can get that from life experiences, you can get that from work experiences, you can get that from, maybe your imagination. But, those are the types of companies and founder personas that we're looking for. So yeah, you can solve problems today that are, obvious, right? And those companies get backed and those are good businesses. But I think as venture capitalists, for the most part, we're kind of looking for those crazy outliers that see something that we don't see. And they're able to, through kind of first principles and some type of analytic framework, explain why the world is getting there and why they're the right ones to pursue this opportunity. And so those are the real interesting archetypes, and unfortunately, no rhyme or reason who they are. Experienced, old, young, we've seen it all and we've backed it all. We have about 300 companies in our portfolio, so we try to do a lot of kind of looking back and trying to see themes and trends. And on that particular one, we don't see a huge theme.
Got it. And what are your thoughts on follow-on investments? Do you think it makes sense to keep an allocation for follow-on investments?
Well, it's interesting. I think my thought on this has changed a little bit. So in kind of 2020 through 2022, we made the decision not to do follow-ons, to take all of our pro rata and do SPVs or offer that to RLPs in different formats. And mostly that was because the pre-seed rounds were almost like skipping a stage. So if we would invest in a company, at the pre-seed and say it was a 6 million valuation, the next round we would see wouldn't be 12, it wouldn't even be 18, it would go to like 25. So we'd say to ourselves, like, okay, we write small collaborative checks. If we write another small check, at a 25 million post-money valuation, the ownership is so small that we're actually better off of taking another bet in a different company, using that cash for a new bet. In the last, 2 years, 18 months, I'd say the market has shifted a little bit. And so now we see companies kind of raising pre-seeds, maybe at that same level, but, their next round, call it a seed, might be at a 12 post or a 15 post or a 16 post. And at that point, it actually can make sense to double down, depending on your fund model. So it's something that we think through quite a bit. We, I would say, discuss strongly in our in our partnership of whether we want to do follow-ons, but a lot of it just comes down to kind of the math and whether the valuations make sense. So I'm a little bit mixed on it. For all the funds that we've done, we've only done one check. So this will be our third fund that we go out and raise in 2025, and we've been a one check only, but it is something that we discuss quite heavily now that the market has shifted.
Got it. And, as of recording, we just had Donald Trump come in. TikTok was banned, but now it looks like, it's going to come on. So I don't know what more surprises are going to be there, but I'm hoping the liquidity is going to improve and we'll have a lot more M&As and IPOs coming up. But when it comes to exit strategies and liquidity events, when do you get to decide when to sell your position in a fund?
Yeah, it's a great question. I also think there's like a little bit of a misperception that like 2024 and 2023 were like terrible years for M&A. Actually, 2024 was one of the best years for M&A in the last decade. So there was a lot of M&A. It's just that I think the big shiny deals that got blocked by the regulators kind of took the forefront, and everyone said, oh my goodness, like what are exit strategies if our IPO market is shut and our M&A market is kind of hampered by regulation? The truth is there were a lot of exits that happened. Okay. And in 2024, we returned more capital than we ever have in 7 years of running the fund. So there are off-ramps. And I think that, you bring up a good point, which is like, when do you sell your shares? And that's a very personal decision based on the fund and the fund model. So if you're running $1 billion fund, right, if you're Andreessen Horowitz, you don't have a ton of off-ramps because you have a huge amount of, cash that you need to pay back to your LPs. So for you to get a decent multiple, you need to, cling on to your winners till the very end, which would be, an M&A transaction or an IPO. when you're a small fund, when you're a $25 million fund, you actually have a lot more off-ramps at later stage, at the later stage. And so we've been able to do some really nice secondaries and return money to our LPs, which makes everyone happy, and it obviously puts more money in the system so that they can reinvest. So it's not a statement on whether we love these companies or, our feeling. It's really just a business model that works for us, which is being able to provide liquidity to our LPs along the way, as opposed to waiting the 10 to 12 years for this kind of monumental exit. And so I take it back to like a real personal approach. For us, it works to be able to do secondaries along the way.
Got it. And especially when it comes to pre-seed and seed startups, I worked in startups where we've not been able to hit the product market fit. But how do you truly analyze product market fit, and what advice will you give to founders, especially with AI coming in and new tools like Cursor and Lovable? It's easy to make products, but how do you truly analyze a product market fit in the market?
Well, we're investing pre-product market fit, so we don't spend a ton of time on that, but let's just say if it's a follow-on investment or something of that nature. I've been a multi-time founder, and I think, it is kind of what you say. It's you know it when you see it, right? Because there's just so much incredible appetite for your product that you can't, barely keep up with demand. So when you start getting the pull of inbound opportunities, I think you start approaching the product market fit, right? So all your friends and family have bought the product already. Now you're like, super believers have bought the product already. Those two rings are probably not product market fit. But when you start, instead of pushing the boulder uphill, you kind of get to that peak where people are finding out about you organically, there's inbound, then you start to kind of approach something really interesting. And I think the challenge is that there can be missed signals along the way, right? You can catch a trend, for instance, right? And so, maybe a year ago with some of the generative AI, it seemed like some of these companies had product market fit because people were rushing to the product. You didn't even have to promote it. But as you say, there's some false starts because you have things around moats and defensibility and stickiness for some of these products. So I think it's really challenging for founders right now. And the real piece of advice I would give is raise enough money that you can get through these, these highs and these lows, and you can really build a sustainable business and control the levers in your business by not overspending. So that means maybe you grow, less quickly, but you really understand the fundamentals in your business and what kind of keeps things chugging along. So, now we're saying to founders, please raise enough for at least 24 months of runway, because there's going to be a lot of kind of learnings, pivots, and fastballs that come along the way that we can't even anticipate today. So make sure that you have the runway to get you through.
Got it. And what do most founders think they know about fundraising, but they do not?
Oh my gosh, I spend a lot of time helping founders fundraise. So as the first check-in, I feel like my job is to get them, through that seed round. And I think many founders think that, if they have a product and things are starting to work, that's enough to fundraise. And I think it takes out the whole kind of human element of what it means to create an impactful story, right? And to have a narrative that stands out. So one of the things that I help a lot of our founders with is, they've kind of raised their round and they're going out for PR, right? And so they think that the PR pitch is about their fundraise. And what I have to tell them is like, no one cares about their fundraise. They care about, something that is contemporary, that it's happening in this moment of time, and how their product kind of interacts with that. So you mentioned a good one, the TikTok ban and what that will mean, for companies going forward. So if you're going to go out for, PR or even to raise capital, like take that narrative and position your company around kind of what generally is happening today and where you think things are going. So I think the thing that founders miss is that they're very much in their heads about them, their product, and maybe their customers. And when you fundraise or do PR or, anything around your company, you need to like take a zoom out and say, like, why does anyone care? What are people talking about more generally, and how do I fit into that? So that's something that we help founders with their narrative quite a bit.
Got it. And somebody who's raised pre-seed and they're looking to raise their seed round, what is the best way to put their VCs to work so that, they can get to the next round?
Yeah. So, getting organized is half the battle.
Right.
So I think that's something else that founders underestimate is just how much time it takes to prep to run a very meticulous fundraise. So there's two ways to fundraise. There's an opportunistic way, which is, associates from funds start pinging you and, you're talking to a few people here and there and you start kind of, getting your materials together and you get kind of pulled into a fundraise by someone else. The other way to fundraise is to be very thoughtful and planful that you want to fundraise and figure out how much you want to raise, what your timeline is, who are your kind of ideal investors, and really spend like a couple of months doing the research on who these people are. Do they write checks in your space? Who's the right person at that firm? What's their thesis? And really kind of be honest with yourself and, about who are the best folks for you. Build that list, be meticulous about keeping it updated, and to your question, putting your VCs to work. Then get everyone on your cap table, not just your VCs, but your angels, your friends and family, to help make those introductions. And so you can run a real meticulous process, or you can be dragged into a fundraise that maybe you want, maybe you don't want, but you just have a lot less control. And I think as founders, we need to kind of take back the control of the fundraise, control, the narrative, the story, the documents, and, create the kind of buzz around your fundraise.
Got it. And should founders always be raising, or do you think, 3 to 6 months is enough time for them to, get to the next round?
I mean, I think it's helpful to devote 5% of your time to maintaining relationships in general. And I say that across fundraising, I say that across PR, I say that across, customers, just spending a little bit of your time cultivating your network makes a lot of sense so that you have a lot of kind of warm entrees into these different areas. So I say always be fundraising a little bit. There's some founders, I think they take it to the extreme, right? Where they're, they just closed a round and they're spending half their time meeting with new funders and that's like all they're talking about. And, I think your job as a founder to build a business and to, create a product that everyone wants. And if you do that, the money will come. I do think on a practical level, it is helpful to have a good network and connections. And so especially if you don't live in New York or the Bay Area, maintaining that connectivity. So, if you live in a smaller tech ecosystem and you happen to go out to the Bay Area to meet a customer, yes, take 2 or 3 meetings with investors that might be right for your next round. Don't tell them you're fundraising. Don't use a deck. Just go have a coffee, right? And I think that can be helpful, but I wouldn't spend a ton of time on it.
Got it. And Jenny, you focus on, a couple of verticals, which is money, health, work. How do you approach sourcing and, doing the diligence for potential investments across these 3 core verticals?
Yeah, so as mentioned, we've kind of pioneered this thing called community-based venture capital, and so all our deal flow comes from those 500 founders and operators who are our eyes and ears on the ground. They help us source, diligence, and ultimately support our large portfolio. So, as we kind of looked at the, few hundred companies that we have invested in, we started to think, okay, where are the ones that are the breakouts? What are the verticals that they're in? And where do we think the world is going? And so we now like to say we invest in the resilient economy. So what is the underlying software, technology, infrastructure, the kind of scaffolding around the software that helps those verticals be resilient going forward? So that could be something in climate or healthcare. It could be something in, fintech, transactions. many verticals, but what is kind of the underlying tech that allows those areas to operate? So like within healthcare, we don't invest in healthcare delivery. That's not really, where we spend a lot of time, but we invest in some of the optimization layer of how these companies can get out there, from a regulatory point of view, from a structure point of view, and really, create the best experience for the end users who are patients.
Got it. And Jen, you've been pretty active on Twitter, but you also launched your own book, which is Venture Everywhere. It's very similar to what your fund is about. But why did you go about launching a book, and what is it all about?
Yeah, so I've spent the last, at least decade, traveling around the world, meeting some of the most inspirational founders. And I mean, you're not in the U.S., so I, count, I count India and some of the, the great folks I've met there. They just didn't necessarily have traditional backgrounds, and yet they wanted to do this crazy thing called Start a Startup. So actually, it's 12 chapters, 12 countries, 12 inspirational founders, and my journeys in those locations. So I have a whole chapter on India. I have an amazing founding team from Tracken that I interview. And when you hear these stories of how the founders met, of how they decided to do this crazy thing, building a startup, and the conviction that they actually needed to leave their jobs and to do something, totally different, it's very inspiring to me. And so the book is really about celebrating these founder heroes that are far from the glow of Silicon Valley, but they've built these really impactful companies. So it's a narrative nonfiction. I think you'll enjoy it. It takes a trip around the world and really explores startup ecosystems in many locations.
Got it. Yeah, no, absolutely. I'm really looking forward to reading the book. And Jenny, you've been very active in the New York ecosystem, but what are some of the unique challenges and opportunities that you've observed outside of Silicon Valley? Because I think London and New York has a very similar ecosystem, but maybe maybe your more thoughts on the New York ecosystem.
Yeah, well, New York was not a great ecosystem when I started my company. So what's been fun about it is to be part of the creation or the evolution of New York. So when I started in 2008, there was no WeWork, there was no resources for founders, there was really no venture capital. And we saw that all kind of come together. So I think the thing to remember is that your small part can be a big part in transforming an ecosystem. I also got to live in London about 2010 as kind of the whole Silicon Roundabout was coming along, and everyone was getting into startups, and that really hadn't existed. There were venture capitalists, and they were all in Mayfair, and all of a sudden we saw this whole new area, an ecosystem develop, and so to be a small part of all of these has been really awesome. And now, we want to see every location become, the next Silicon Valley. And I think with, more dispersion of founders, more wealth being distributed, more platforms like this one we're using, Riverside or Slack or whatever it is, I don't think that you need to be in one location. In fact, people really never know where I am. It's always this big joke whenever I get on a call. People are like, "Where are you, Jenny?" So I could be building the New York ecosystem, but I could be in Australia and you wouldn't even know. And I think that's what's magical about right now is the digital world and the physical world are really merging in an amazing way. So it's been awesome to be part of the New York ecosystem, tech ecosystem develop. I'm a professor at two universities, Cornell and Columbia, and I just love being able to inspire the next generation of students to go out there and build. And I'd love to see more people around the world kind of stitching those things together, right? So it's academia, it's startups, it's corporates. There's just a lot of players. And I think you need to kind of bear hug them all to really build a really unique startup ecosystem.
Got it. And you've been in the ecosystem for such a long time, and I've seen new syndicates come up, crowdfunding models. But what are your thoughts on the future of pre-seed investing, especially with AI coming in 2022? How do you see it evolve in the next coming years?
Well, I think as investors, we all have access to like much better tools that frees up our time to do things that we want to do, right? So if we don't have to spend endless amounts of time researching and deal memos and synthesizing information, we can just use Granola to record and, all these great tools. Honestly, that frees up my time to do what I love, which is spending time with founders. So I think the way it's going to impact us at, the first level is going to be, it's going to make us much more efficient. And again, as I mentioned at the beginning, running a fund there's a lot of infrastructure you need to maintain. So if we can do that more effectively and efficiently, I think that's going to be, great for our time and really for our ability to reach more founders. The second order is a little more interesting. It's like, well, will you actually need VCs? In the same way that I think that conversation is happening, like, well, will you actually need lawyers and will you actually need any service providers? I don't really have the answer, except to say that I'm open to the possibility that it all changes, whereas I feel like the lawyers are not open to that. When I tell my lawyer friends that the whole empire that they've built may come crumbling down, they look at me like I'm crazy and they don't want to talk to me. Whereas like I feel more open to that as a possibility for venture capital. Like maybe I won't have a job in 5 years. And you know what? Like that's fine. I'll keep on building and going where the interesting opportunities are. So, I think in the short term, not a ton is going to change, except hopefully for the better, that we have more time freed up for founders. In the long term, where there'll be kind of a marketplace using AI agents that doesn't really require me to be there, that efficient capital can be, connected to great founders. Like, I'm open to that.
Got it. Interesting. And, I quickly want to do the top three. What's your favorite business book?
Well, this is kind of interesting. I just reread The Innovators by Walter Isaacson, and it's an old book, but it gave me a lot of inspiration for the future. So I sometimes think like going back and revisiting older books is pretty great.
Got it. We'll put that in the show notes. And, if you could go back in time when you started Everywhere Ventures, what is the one thing you would have focused on or done things differently?
Oh my gosh, that's such a good question. I think we expanded pretty quickly. And with that, we covered a lot of ground. And so we probably should have been a little bit more planful about where we wanted to go and why. And I think, like many founders, you feel product market fit, you feel the pull of different geographies, and all of a sudden, like, we wanted to be there. So maybe a little bit more planning on how we rolled out Everywhere Ventures everywhere.
Got it. And what's your favorite online tool? For example, Gmail, Slack, Zoom, ChatGPT.
We run our whole community on Slack. So we have 1,000 founders. We've exchanged more than 1 million Slack messages since we started it, and 0 cat memes. It's all founder resources. So there's a lot of fancy tools out there, but that one is really critical for us.
Got it. We'll put that in the show notes. And Jenny, what's the best way people can reach out to you and know more about your book?
Yeah, so you can connect with me on LinkedIn, and Venture Everywhere is out soon, so check it out on Amazon, and that's it. Follow me on Twitter.
Awesome. We'll put it down in the show notes. Jenny, thank you so much for taking time speaking to us. I really enjoyed my conversation with you.
Thank you, Rohit. This was great.